Welcome back, everybody. I'm Jeff Barton. I'm your voice in the mortgage industry. 888-713-2929, our telephone number. Pick up the phone, give us a call, ask us questions about your mortgage, about, the spring buying season. Yes, it's here, and so if you're out there and you're looking for housing, although I got to be honest, there are many of you who have stopped looking, and there's reasons for that, and I want to get to that during a couple of the segments of the show. One of the main topics for today are the difference between being young and being old. And one of the things about being old is that you face what we all consider retirement. But we'll get to that, too, in a second. Again, I'm Jeff Barton, and welcome to the show. We are on each and every week. KCAA, KMET, and K-Tahoe. All of these fine stations cover a lot of California. And if you're out there in the IE, the Inland Empire, and certainly northern parts of Orange County and east parts of LA County, you're going to hear the show on the weekends. We broadcast probably 5 times a week, and we try to bring some good information to you about what's going on in the mortgage market as well as in the real estate market locally. We have a couple of great guests for you today on the show, and one of them is a real estate agent out in your area, Arturo Martinez. Been on the show a couple times, but not for a while. He's going to give us some insight as to what's going on in the real estate market in the IE, in the Inland Empire, San Bernardino and Riverside areas, because I think we need to understand what's happening right now in your area. And what is happening is that there's a lot more product on the market today than there was a year ago, which means that prices have slowed in terms of the rise. I was reading an article that said it was about 6% year over year, which is, again, still pretty good. I mean, if you're thinking back to those days when you were just hoping to maintain the value of your home, well, certainly we're a long, long way from that. But there are those people who are looking at the market today and saying, well, are we in a similar situation that we were in, let's say, 2006? Now, in 2006, I don't know if you all remember, market was booming. People's house value were going up about 10% a month for a while. And so what would happen is you'd refi a person 2-3 times a year just so they could take the equity out, because that's how much their properties were worth. And because interest rates at the time were still pretty low, I don't know if people remember that those were the years by which the Fed was lowering the interest rates at the same time paying for the federal government, the Bush administration, paying for 2 different wars, one in Afghanistan and one in Iraq. Off balance, about $4 trillion worth that weren't accounted for. And so in order to keep the country moving and growing economically, even without that particular big hit on the books, Alan Greenspan was lowering interest rates. So that was what was fueling the economy at the time. Now we look at the economy today and we say, well, we're nowhere near that. But a couple of things that are important about that is the rise in real estate prices rapidly over the past 3 to 4 years, although I said 6% now year over year. But it was up to, 10%. Some pockets of the country were 15, 16%, Las Vegas, Nevada being one of them. So those particular things are similar. Another thing that is similar to that time is the money supply, and how the money was cheap. And believe me, it's cheap today, even though the interest rates have gone up, and that's another thing to talk about. Interest rates 2 weeks ago were about 3.75 to 4.125%, depending on your credit score, on a 30-year fixed rate, 20% down mortgage. Now, credit scores nationally fallen to about 713. They were at 740. Now, 740 is an excellent credit score. As everyone knows, it goes 450 up to 850. Credit score in total. And that's another thing. FICO scores themselves have been really derided recently as a non-reflective look at someone's history or credit. And the softening of those standards in your credit reporting is what's, again, similar to what was happening in 2006 to what is happening today. So if you're looking at your credit score and you're saying, okay, I've got a 700, let's say, and you're thinking it's pretty good. Well, is that because your credit is as good as it was as if you were to have your credit score given to you or that you earned in 2011, 12, 13? The credit standards at that time were different. And the way that your credit score is calculated today, is that the same as it really was back in 2006, which is kind of what we're looking at in terms of danger signs to the overall economy, certainly the housing market in 2019. Now, the parallels are similar, not exact. That's why people watch these sort of things. And if you're out there and you're looking for a loan and you're looking at your credit score, just understand that how your credit score is calculated may be different than it was calculated 2 years ago, which is why maybe it has risen. Yes, you have to pay your bills. Yes, you have to pay them. And there is what they call the revolving credit that you have on your credit cards. If you're below 30%, that's going to improve your credit score. Maybe you're one of those consumers that have done that. Or maybe you're one of these consumers who have certain types of debt that used to be reported, aren't reported anymore. That's going to improve your credit score. But these issues with credit, which allow you to borrow money, and another reason we have to be careful is the expansion of certain types of product out there in the marketplace. That product being stated loans, bank statement loans, business loans, loans personally against your business bank statements. All of these loans, albeit you need at least 20 to 25%, maybe 30% equity in them, meaning that you got to come to the table with that amount of money if you're purchasing. Or if you're refining, you can't refi out more than having 30% equity into the property. That's the safeguard in this economy. Also, those types of loans are not being bankrolled by Fannie Mae, Freddie Mac, or Ginnie Mae, i.e. the conforming 30-year or your FHA loan. They're being banked by independent, either insurance funds, Wall Street. When we talk Wall Street, what are we really talking? We're talking about what is the return in the stock market versus what is the return if you bankroll these types of loans through bundling them up, purchasing them outright, and then creating a product by which you can sell back to the market, i.e. a bond. Let's say that your overall bundle, the amount that you're making on that bundle is 5%, and you want to sell a bond at 4%. Well, to a lot of people, 4% is still pretty good, depending on your level of risk, and the level of risk in this pool is X. We don't really know because I don't rate them. Moody's does, Barron's does. These are the type of companies that rate bonds, especially private equity bonds. But if we looked at the market today versus the market in 2006 and draw some parallels, this is also one of them. And by the way, when we're talking about mortgage-backed securities, which is the bond, the product that you would deal with in the private sector versus in the public sector, I asked a guy the other day, I said, look, if we looked at, and this was somebody from Homebridge, a guy that I've known and came to the office and we were talking about the business, the industry, why the consolidation, why certain companies are going in and out of business. How come we have rate wars going on between United Wholesale Mortgage and Quicken Loans, just to name a couple. So he was interesting. But I asked him, I said, why, or rather, what is the percentage of private money in the mortgage industry now that you have all these non-QM loans, the loans I spoke about, the bank statement loans, the stated income loans, the business bank statement loans, these hybrid non-qualified mortgage non-QM loans? What is the percentage of those types of loans backed by private money in the overall 1.6 or $7 trillion mortgage industry this year? He said 30%. Now think about that for a second. 5 years ago, it was more like 1%, 2%. But the explosion of the new types of products in the marketplace, not government-backed, i.e., when I say government, I say quasi-government. I mean Fannie, Freddie, not backed, but purchased by the secondary market. That's a healthy trend and different than the way it was in 2006. Anyway, I'm Jeff Barton. I'm really happy you're listening to the show. Got a great show coming up, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry, 888-713-2929. That's our telephone number. If you pick up the phone and give us a call, we talk mortgages and money-related items on the show, also real estate locally here in Southern California. Welcome, everybody from KCAA, KMET, and K-Tahoe, all our great affiliates out there who do tune in each and every week, Saturday and Sunday, usually on Thursday as well, to listen to the show. If you have questions, write them down. The phone number, call me later, leave a message, and we'll definitely get back to you. And if I can't help you, we'll get somebody who can. I want to get to Randy on my show right now because I've known Randy Credico for, how long is it, Randy, 40 years?
35.
35 years.
Yeah, 84, I think. 83, I think I first met you.
And we've talked on the show here many times about my relationship to the comedic world and the people back in the late 80s, from 1979 to 1989, who I knew in New York City. Some of them have made great strides in helping others. Randy is one of those guys who's always been a champion for lesser than and people who need somebody to speak up for them. Randy has recently been in the news. People may recognize his name. But Randy, how do you deal with the stress of that kind of attention on you all the time?
Well, when I was 20 years old, I made my way into show business, and I was looking for attention, and I was looking for fame, and you got to be careful what you wish for, because eventually it might come, but it may not be the flavor that you were yearning for. So, but I was out of the business for a long period of time, just doing criminal justice, activism, helping people get out of prison. Those are really the most productive years of my life, because I've always been an activist. But as a comic, I use comedy as a vehicle. Later on, when I met you, I was more using comedy as a way of focusing, using my abilities to focus on injustice and against wars and things like that. So.
Well, you were one of the first.
Now it's morphed into this. The last 2 years, I had this very successful radio show in New York.
Yep, BAI in New York. Yep.
Circumstances, these weird circumstances happened. One of my guests on the show, ended up being in this congressional investigation, and then the Mueller investigation, and suddenly I got wrapped into all of it. I got subpoenas from the House Intel, the Senate Intel, and now recently from Nadler's committee. And I've been in front of the Mueller investigators 6 or 7 times. I've been before the grand jury, and whatever emerged from that. There's a trial coming up where my testimony is 5 out of the 7 charges. So it's really surreal, the whole thing. And I am getting, the problem is that I was a bystander, pedestrian on the sidewalk that got hit by a bus, and the driver is like blaming me,
Right.
So, but then again, it was all about this thing with WikiLeaks, and I'm close with Julian Assange.
Yep.
I had him on my show 3 or 4 times. I've been to the embassy, but all after the election. I didn't really know him until after the election when I went to London, and I started a long series on Assange the following year after the election. But, I had him on my show one time, 2016, and that's where, this whole car wreck revolves around. And so, like I said, I've been dragged into it, and the fact that I may have to testify, I really don't. It's like who wants to testify in a trial?
Nobody, right?
So I'm just. The thing is that I got people, the Trump people, who dislike me because one of their guys is the one who is my antagonist, Roger Stone, and then the Hillary people, the liberals, not the far left, far left always likes me.
Right. No, you have good politics there. I agree.
Yeah. All right. So, but the liberals, the Hillary people,
right,
they think that I had something to do with helping Trump win. You know, I live in New York. There's no way that Trump won New York, and I didn't even vote that day. If I had, it probably meant Jill Stein. But
right.
I had a radio show to do, and I was that Tuesday on the 8th of September. But people looking of November 8th, 2016, they all think that somehow, the one side, the Hillary people think they're looking for scapegoats for this, you know, her losing. I certainly did not give her a map of the U.S. or campaign team, a map that excluded Michigan and Wisconsin. So I don't want to take the blame for that. And plus, you know, there's a number of reasons why she lost. I mean, I'm not happy. It was a dreadful day for me today.
Right.
That I realized early, like 8 p.m., I could see that Trump was going to win, and I slunk out of the party at Jill Stein's headquarters, and was so depressed.
Right.
That, you know, just like went to sleep.
Let me ask you a question about BAI and your association there. I understand.
I don't like to bring them up because I've divorced myself from them right now because of the corrupt management there
right.
that I exposed back in 2017. You know, it's a progressive radio station.
Right.
But the engineer right now has hijacked the train, and but it will go back. In other words, it will survive. WBAI just going through this transition. You know, they wanted me back. I wouldn't go back until after they straightened out the management. There's a number of reasons why I didn't go. I didn't even do my radio show from this station. I
right.
was having such problems with, you know, people. One of them got fired. The one that fired me, he got fired. But on a lame excuse, they just didn't like my independence. And the fact is, I exposed so much internal corruption there, and everybody knows about it. And so now I got elected to the local station board, and
I saw that
management's going crazy because, you know, I'm going to use every fiber of my natural ability for activism to expose what's wrong with the station and get it back on track, because it has it is historically a great station. It's just that the person that founded it would certainly not be happy with the direction that it's in. And like I said, I could have gone back, but I just did. But why? By my silence, you know, I took a stand, and some people crossed the picket line there, didn't stand up, but that's what they have to live with that, and that's
right.
be their legacy. My legacy is not to sell out under any circumstances.
Let me ask you quickly about a couple of things. U.S. Treasury policy, the Fed, some of the money and the situation with the banks in the U.S., and how are you plugged into any of this in terms of trying to understand why it is the way it is and the banking powers that be the way they are? Yeah, give us a couple of comments on that.
From a layman, you know, when they repealed Glass-Steagall, which was done by my senator Chuck Schumer, and
right.
the Southern pal of his, Senator Graham,
Lindsey Graham, yeah,
they did that, and Clinton immediately signed it. His friend Bob Rubin took a hike and cashed in on it. When they stopped, you know, when they repealed Glass-Steagall, it opened the door for real abuse, and you know, it took 8 years for it to really play out.
Yep.
And, you know, the banks have gotten a sweetheart deal. They were bailed out. Wall Street was bailed out. The average person wasn't bailed out. But, you know, the too big to fail idea is that these guys could do whatever they want, and they got away with it. And so I think the average person is not happy with it. Right now, to me, it looks like they're keeping interest rates low to pump up the stock market, and so this is a sugar high that we're on. Sooner or later, the excrement's going to hit the fan in a big way, because this is being artificially pumped up. The stock market is that people, you know, like, well, they get 0.5%, or I may as well put it in the stock market, and that's just a huge rigged casino, man.
Yep.
You know, it's a rigged casino. So You can't put your money in savings. You put it in the stock market, and then people who know how to manipulate it, they pull the string like they did a few months ago, and the stock market went down, a big correction. Then they put the money back in, some of the profits, and it's gone back up. But, this is, like I said, running on fumes, and and I think it's designed to somehow stay like this until after the election.
I agree, 100%. Hey, listen, Randy, we're up against the clock.
Bad. I mean, I feel bad for people who have all their eggs in
their retirement accounts, absolutely right. Pension accounts, teachers' unions.
Everybody pulls out. Why don't everybody take their profits? If everybody were to take their profits, I mean, none of these companies are worth what they're valued at, because if everybody decided to pull out and put their money in the savings, the stock market would dwindle, and the people at what it is a pyramid scam. It's the same as, I remember you go, when I was in California, I grew up there in the 70s, a couple of my friends made a lot of money. They'd go to somebody's house, and they put up $1,000. They had to bring in 4 people, and then they put $1,000 underneath it, and then they'd be driven to the top, and they'd get like $8,000 back because they brought in people, and that went on for a while. And then suddenly, the roof caved in for everybody else. It got sucked into it. Well, that's what's going on right now. It's just, it takes hard work to earn wealth. It can't be doing it the way everyone thinks.
I agree.
It's magic money that's being developed here. It's not based on production.
Randy, thanks for coming on the show. I want to do it again at some time. I know you're a busy guy. I feel for your stress.
Is that okay for a guy who's a layman? Doesn't really,
You know more about it than 99% of the people out there, because you can see it. You've seen it for 30 years. You've been watching it. So,
it's a pleasure being on the show, Jeff. Keep up the good work. I'm happy that you found your calling.
Thanks, Randy.
Job.
Thanks very much. That's Randy Credico. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. 888-713-2929. That's our telephone number. If you pick up the phone and give us a call, we can help you answer questions about what's going on in the mortgage market, as well as in the real estate market in the Inland Empire, as well as Southern California and certain parts of the Tahoe region up in Sacramento in that particular area. We're here, we're on it, and we're ready to help. With me right now is a guy who's been on the show before, who runs and owns a real estate company, Executive Capital Group, Arturo Martinez. Arturo, how are you?
Hi, Jeff. How are you?
I'm fine, thank you. Can you pick up your handset? Is that okay? It's just that we've got a little echo in the background.
Oh, okay.
Thank you very much. So, how are you? How are things out there where you are?
Well, things are good. The weather is nice.
Yes, it is.
Fine. People are going out to the open houses. Market is picking up.
So tell the audience exactly what cities you are in, where you're located, where your office is, things like that.
My office is in the city of Montclair, and I cover all the Inland Empire, Riverside, Orange, and Los Angeles, some part of Los Angeles.
Okay, excellent. So real estate values, we see that real estate values have come down a little bit, even though they're increasing. They're not increasing as much. And with the low interest rates, are you finding there's more buyers in the marketplace?
Right now, people are buying. The prices, they're kind of like, they're not dropping as, people think they're going to drop like, years before.
Right.
But the values are kind of like a standing, stable.
Right.
There is a lot of inventory, but if the property is priced correctly, it will sell within days, that's what I'm seeing. There's properties that have been on the market for maybe 30, 60 days.
Sure.
But they had to drop the price. But there's also properties that they are priced well, and they'll sell right away.
What I've found in the business is that the agent really does want to sell the house, obviously, but that's not the reason that they price a house. Pricing a house has a lot of variables to it. Explain how you price a house.
Well, we check the comparables around the property that we're going to list it,
Right.
We see all the amenities that it has. We compare one house to another. It's difficult to compare exactly one house to another because we don't have access to the comparables.
Right.
But we have descriptions of what the property has, if it was upgraded or if it's dated. So that plays a lot of positives and negatives on pricing a house.
Okay, and now tell me if you've heard this before. You're sitting in a listing appointment, and the seller turns to you and says, "I have to get this price." You ever heard that before?
Yes. Yeah.
What's your answer when a seller says, "I need to get X amount of dollars"?
Well, I think always be honest with your client.
Right.
You have to tell them, we can price it at this amount. We can price it even higher if you want it to. But the question is how soon you want to sell the house, how soon you want to move on. Because if you price it at this number that you're requesting, the property is going to be sitting there. You have to be forced to lower the listing price. And probably you're going to end up selling it for even lower of what I suggested.
Yeah, no, I agree. I think what happens with a lot of sellers is that they fall in love with the way the market was, not how the market is.
Right. And it's very important that we educate our clients.
Right.
Explain them how it was back then and how it's now, and the advantage of them selling quicker or waiting for the pickup season.
Mm-hmm.
But is when you're ready to sell, it doesn't matter if it's winter or summer. If you price it well, it will sell.
Yeah, no, I agree with that, and I think if the expectations are, I guess, tempered, meaning that you go in with an honest appraisal of what's happening in the neighborhood. Every seller I know says, yeah, but, and I always say, no, listen. The neighborhood in the market is going to dictate what the price and what the house is worth, not because you have added tile in your bathrooms. It just doesn't work like that.
Right. One of the reasons, or not reasons, but one of the things I said to my clients is, if you put nice tile in your bathrooms, if your kitchen is upgraded,
right,
of course it's going to add value to the house, but not on the hundreds of thousands.
Right, that's right.
It's going to add value, but it's going to sell quicker. Your house is going to be in front of the line of hundreds of properties, so yours is going to sell before because it's well taken care of. Yeah,
and that's the key, right? You want something that looks and actually is well taken care of, that the appliances are clean, that the flooring isn't stained, right, all this kind of stuff, right.
Yeah, exactly, yes. And, there's, of course, different buyers for different type of properties. All my buyers, they want, a house that is maybe needs some repairs or TLC, something they can buy, a little bit less expensive or less cheaper of what they want to pay. But also there's people that they just want to move in. They don't want to do anything.
Well, that's true.
It is ready to move in.
Now, do you represent a lot of people that want to get into the flipping business? I don't know if you have clients like that. I
do. I have a portfolio of investors. We were doing a lot of business, when the market crashed, and then even after, when they bought the properties and it was time to sell, they were given the properties to sell. So they were rented, they were tenant occupied. So we had to give notices, hire a crew of contractors, and they went and they redid the house, and we put it, like turnkey house.
Right.
So it can be sold very quickly. So we did that.
Yeah.
Right now, the properties are more scarce on, there's not too many properties that you can flip. But, the investors, they have patience, they have money, and when something comes, an opportunity, they jump into it.
Yeah, it's interesting because in markets all over Southern California, the prices here in every county are really high. I mean,
Yes.
and when I say really high, I mean if you're looking at $500,000 as a fixer or a flip, that's a high price to pay for something that
Correct.
you're trying to sell for 700,000 or 650 and put 50 into it. I mean so finding opportunity, doesn't it really depend on the appetite for, I guess, risk or investment, how much money you have?
Yes. The investors, they did have an expectation of net return before.
I see.
Now they are, they know how the market moves.
Right.
So now their expectations are lower. They're looking for a house that they can, make some, no $100,000, but some profit. So they're adjusting their net profit, and there's always the house that needs to be redone, or the people is in a hurry to sell it, and we don't have months
Right.
to be sitting on the market. Probate is another way to also bring
Sure.
your investors.
Probate's good, especially if you have a probate whereby the client dies intestate, so basically without a will.
Exactly.
The heirs are probably wanting to get rid of it very quickly so that they can, sort out the differences of what each member is going to get, and the opportunity is great at that point. Tell me, we have about a minute left. The financing of these properties, are you seeing more qualified mortgages or more non-qualified mortgages?
Well, it's both.
Okay.
Right now, the lenders are becoming more flexible and then bringing more programs that are easy to qualify people that either that has a lower FICO score, or it doesn't have enough money, or they has plenty of money but no credit. So, there's a loan for everyone. We just have to look correct.
I see. Okay. Hey, Arturo, shout out your phone number for those who are listening on the radio right now who want to get a hold of a terrific agent out in that area.
Thank you. Thank you so much, Ed. My
Sure.
number is 909-263-5344.
Okay.
909-263-5344.
Excellent. Arturo, thank you very much for coming on the show.
Jeff, thank you very much, and hello to all your listeners.
Thank you very much. And that's Arturo Martinez from the Executive Capital Group. And I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. 888-713-2929, our telephone number. Pick up the phone, give us a call, and we can help you with your decisions you're going to be making about either your house purchase, maybe you want to sell a house. Lots of reasons to take money out of that house. If it's something you haven't really touched in the last 5 years, you probably have a good deal of equity into that property. We talked earlier segments of the show about what's going on with the economy. We had a great couple of guests on talking about that, as well as how we got to where we are today and some of the warning signs that are popping up either locally or nationally in the economy as well as in banking circles. I know we historically look at what happened during the Bush years and how Alan Greenspan artificially lowered interest rates. Now, he's an economist, and I'm sure there were excellent reasons to do so, but essentially what happened is that the country went to a party while fighting two different wars, which were unaccounted for $4 trillion, which eventually I think was one of the major components that never gets spoken of about the recession in 2008. Certainly there was greed in many different respects. Randy Credico, earlier guest on the show, talked about the Stigler Act, which was repealed, and that had to do with banks not being able to invest in Wall Street. That was really the last domino to fall, which allowed speculative investment by banks into Wall Street, which really led to a lot of the uncertainty in the marketplace. So when the crash happened, there were new stipulations put on the stress test. Remember the stress test? Well, that since has also been lessened by the Trump administration. So there's a lot of things that have happened in 2006 and 2007, which are very similar to what's happening today. I think there's more private investment today than there was at the time, especially in loans. Now, we used to have these pick-a-pay loans. Everybody knows or remember what that would be, whereby you would qualify for a particular loan, but you could choose how you would pay. You would either pay the interest only, you'd pay some of the principal, you'd not pay anything for a month. It was that World Savings was a big one in those days, and then all the banks got into it. It's very similar to non-QM, what they call the non-qualified mortgage. Now, a qualified mortgage, as everybody knows, means that you have an ability to repay, you have certain FICO scores or certain credit scores that you adhere to, and you have a front and back end ratio, that is a debt to income ratio and a loan to value, loan to income ratio. And these things put in place qualify you to have the mortgage purchased by Fannie Mae, Freddie Mac, or Ginnie Mae, which is your FHA purchaser. However, if you are outside of that, i.e. you've got let's say you have $1 million loan, well, you're not going to qualify for a QM loan. That's everything in the conforming sphere. Now, high balance conforming is anything in Los Angeles and San Bernardino counties, I believe up to 623, 723 in that range. LA's higher, obviously, because the values are higher. And Orange County is certainly higher than both those two counties. But if you're over that, that is what's considered jumbo loan, and that, of course, doesn't qualify you for qualified mortgages. Now, there are many lenders out there who will do high balance or jumbo loans. They want to do those loans. Why? Because the amount of money you have into the loan is a little bit higher, and also if you default on that loan, there's more of an opportunity for the lender or whoever lends you the money to foreclose and take the equity in the property. Now, there have been obviously issues with fraud recently, and we've talked about it ad infinitum on the show, i.e. employers who aren't real, bank statements that aren't real, credit scores that aren't real, and how they're made up and how they're doctored, and all of that is basically what happened and is happening and continues to happen. But the delinquency rate in the U.S. on mortgages is really low. Article quoting today from Jan Swanson. I want to thank Jan once again from Mortgage Daily News, who prints these terrific articles that we use every show or almost every show. Let's see. We usually do this about once every 2 or 3 months. It's time now. Mortgage delinquencies are down. Other consumer debts creep up. Okay, let's look at that. 30 or more days past due, including loans in foreclosure. That's 4%. So if you're past 30 days from the last mortgage payment, that's 4% of the loans out there. Okay, so let's think of that. I have a company that does, let's say my company does 500 loans a year. So 10% of those loans would be 50, 5% would be 25. So a company my size, 25 loans in delinquency where a notice of default would go out. Now, a lot of you out there are thinking, okay, notice of default. I know what that is. I can go on a site, I can pay to get that list so that I can write them and see if they want to sell me their house at cheap and I can get a good deal. I've had many, many clients say, what's the list? Give me the list. What, this notice of default list is not a way by which you can go out there and get people's names and addresses and that they're going to sell you a property. I mean, if you do 1,000 and you get one person who may want to talk to you, that would be a lot. Why do I say that? Because I've done it. When I first got into business, that's all I did because I didn't know anything else, but I knew how to get this notice of default list. So that list, 30 days late, right, that's what that list is. So if we go down and look at 30 to 60 days late, okay, that's 2 months late. That's a little bit different. That number is only 1.9%. So it's come down from 4% to 1.9%. So most people, after 30 days late, they'll make the next payment. Why? Because they don't want to lose their house. Let's face it. With the equity already in houses, even if you bought a house 3-4 months ago, you've probably got some equity built into it because prices have risen. Not as sharply, but they have risen. So if you're one of those people, you're probably going to pay your mortgage the next month. You may have gotten into trouble. Maybe you had some health issues. I mean, there's all kinds of reasons why people miss a payment or are late on a payment. So the next category, of course, is the all telling 3 months or more late. If you're 3 months late, you're in trouble. you've lost a job. And by the way, in 2007, 12 million people lost their jobs, and i.e. became in this category of 90-day late or more. 12 million. Think about that for a second. That's a big number. 12 million loans went into default. And because of that, we had the largest recession that we've had since the Great Depression. Some might call it the Great Depression, and some might say that as a result of easy, cheap money today, we are artificially keeping ourselves out of the next recession. Saw an article today that quoted exactly that. Hey, the regulators have stepped in. Well, what does that really mean? It means that money is cheaper. You saw what the Fed did. We were on a track to go 4 more rate hikes this year because the economy was booming. That was 6 months ago. Right now, we're on track. No rate hikes this year. Matter of fact, President Trump calling for rate decreases, i.e., decrease the rate on your credit card, decrease the rate on your auto loan, decrease the rate that is a short-term borrowing, because free money, cheap money keeps the economy humming. And if this president is nothing else, he is about keeping the economy humming. Now, people may doubt why he's doing that, but I'm not here to discuss that. Bush did it by keeping rates low and keeping the money cheap with Greenspan, and this president wants to do it as well. Although Jerome Powell, he has been much derided by this president. This president derides a lot of people, puts a lot of people down. But this particular Fed chair has really signaled that he's willing to wait a year and see what happens with the economy. I think it's prudent, although I do still think it artificially props up what's happening in the economy. So these 90-day foreclosure rates, let's look at that for a second. They dropped from 2.1% to 1.4% year over year. So this tells you that what we really have is somebody that gets into trouble for a couple, 3 months, but then ends up paying again. And I think that's a good thing. I think that's because jobs are plentiful. I understand, based on my reading, 77 million people still can get a job who don't have a job, because that's how many jobs are left right now in the U.S. economy unfilled. Now, that has nothing to do with skill. That has nothing to do with the type of job it is. These are just general numbers of jobs available versus people who cannot fill that job. Anyway, hope that was interesting enough for you. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. 888-713-2929, our telephone number. Pick up the phone, give us a call. We are here on air for you to answer questions about what's going on in the real estate market, what's going on in the mortgage market, what's going on in the general economy, how things are going to look this year and possibly into the future. There are some issues, difficulties, other things that we're talking about on the show today. And thanks for listening in. KCAA, KMET, and K-Tahoe, 3 of our affiliates. I think they're on 5 radio stations, both AM and FM in those areas. And if you go to those sites, KCAA, KMET, on their .com sites, kmet.com or kcaa.com, you can actually see this show via what we do each and every week. We record by video as well as audio. We broadcast audio, and we house this show on video for them to show during when we're airing the show. So if you go there, you can see what we're doing. Also, you can go to YouTube. If you go to YouTube, my particular channel is Jeff Barton, the Real Estate Voice. And if you go there, you can see every show we've done for many, many years. Daryl, thank you very much again for helping us always.
My pleasure.
I want to talk now about retirement age. 2 things on the show this week were the young'uns, which I consider anybody under my age, which is almost everybody, and the old'uns, and what's happening with baby boomers in the retirement years. Daryl, how many of percentage-wise of baby boomers do you think have already retired?
I wouldn't say that many at this point. I think that's still yet to come, but maybe, 20%?
47% are already retired. Now, baby boomers born between 1946 and 1964, ages 55 to 73. So
okay.
we're almost halfway through our...
Yeah, I wouldn't have gone back prior to 1950, I don't think. So,
yeah. Well, here's the thing. When I was talking to my brother yesterday, okay, he lives in New York City, and upstate New York in a little county called Columbia County. He was telling me he retired, right? And he's a year and a half older than I am. I'm 64, just turned. And I started to ask him about, his retirement and, because this is what old people do. And one of the frightening things in this article I was reading, I asked him about. I said, look, are you saved up for retirement? And he said, yeah, I worked for, all those years. And he worked in radio. He was a sales guy for Court TV as well as Wall Street Journal Report and CBS Radio and a number of different outlets. But he was on the business side, so they had a pretty good, I guess, retirement. So he's saved up. But there is such a lack of savings that I have to, okay, percentage-wise, how many people in our age group, Daryl and I are in the same age group, what percentage-wise, how many people have savings at all?
A much
percentage.
Lower, 25.
This says only 30% of older boomers expect a pension. As for personal savings, I'll make it simple. Most baby boomers have not saved nearly enough. In the worst case, it's really bad. 45% of boomers have zero savings. 45%, that's half the people our age have nothing.
Yeah, my wife is going to have a milestone birthday this year, and she said in order to get full Social Security, she was going to have to work another 7 years. And I said, oh, my heavens.
Oh, my heavens.
7 years. 7 more years.
Oh, boy.
I can't imagine such a thing.
Well, and I asked my brother this too. And the reason we bring this up is because fixed incomes, that's what we're talking about, Social Security. If it's your sole source of income.
No, I was just going to say, if you wait the 7 years, who knows what's going to be available in 7 years?
Absolutely right.
I mean, it could be wiped out, abolished, replaced.
My brother said, heck no, I'm taking the money now. I don't know. And I was, because I was asking him, personally, I was told, and this is true too, if you wait until 70, now my age group, different than his, has to wait till age 67. You cannot retire.
That's the number my wife was looking at, 67.
Right, exactly right. So I have to wait until 67 before I collect. However, if I wait till 72, I almost double the amount of money I get.
Yeah, but, there's a quality of life issue there, too.
No question. I can eat beans, but not all the time. You know what I mean? I know what you mean. I mean,
but once you wait till 72, you may not be, ambulatory enough to go out and actually enjoy the double the money that you get.
Okay, so I'm 64. Let's say I can wait another 3-4 years. I have to wait till 67 anyway, so that's another 3 years.
But you're also a triathlete.
No, I'm different. Right.
You're the epitome of health.
No.
Right?
Look
up 64 in the dictionary and take a look at what 64 looks like to the normal guy.
No,
right?
you're absolutely right.
Take the money and run.
So if you're out.
Or trot or
whatever you do, just
away,
get it now and get it in the system that you continue to get payments, because it's one vote away from having the whole system revamped, right? I mean, let's think about it.
Yeah, no. I mean, what's your body fat?
I don't know.
It's maybe 15%?
20 probably.
20? Yeah. 20's good.
20's good.
20's a good number.
20's a good number. No. I looked at a chart the other day, and this is silly, why we're getting off the subject, but I did look at a chart, and it did show the different age groups, and I fit into the lower one. So.
But, being your physical fitness has a lot to do with retirement and money and when you're going to take it out and why. I mean,
you're absolutely right.
Yeah.
You're absolutely right. And because of that fact, let's say you wanted to sell what you have and go buy something else, right? A lot of people do because
or just hit the road,
Well, but however it works, a lot of people their retirement is in their house.
Yeah.
There's a lot of people, probably half the homes in America are paid off, right?
Yeah. I mean, are you working for that money for yourself or for your kids or for your I mean,
that's right.
Yeah.
I don't know.
Just to pass it on?
Well, the reason I bring up the Social Security thing and whether you take it out early or not, and you want to sell your house and you want to buy something else, is because you have to prove some kind of income, right? Now, there are things called reverse mortgage purchases, which is different. There's requirements for that, and you can go that way. However, purchasing a house still requires some kind of income, and Social Security is your income.
Right. Buying a new house when you're 60 and saying you got payments for the next 30 years is sort of a...
Yeah, it's pretty good. Let's say you get a couple grand a month. Well, you can go in a lot of places in this country and for half that amount of money, afford a house. At 5%, that's a $200,000 house at simple interest.
I mean, I had a 3,000 square foot house, and somebody said, "Oh, well, you can rent something in another state for that for about $1,200 a month."
Nice.
Go on.
Yeah, exactly.
Oh, really?
Thank you.
Oh, really?
That's Mr. Happy Guy. Your neighbor
exactly.
is always saying that.
Got to crawl to Mr. Happy Guy's state.
That's so funny. Okay, so another thing that they talked about for people our age is that, understanding your health care costs, right? Now, signing up for Medicare, it's something I got to do. It's the law.
Yep.
64 and 9 months, you got to get signed up. So asking him about health care and how that reflects. He had cancer. So for him, it's a no-brainer. He got to get on it.
Yeah, got to.
Got to do it.
But you also need some sort of supplement because
he's got that too.
Medicare only covers like 80% a lot of times, even with office visits and emergency.
He said he had United Health,
yeah.
And that helped him, right? Now these costs and expenses in the housing market are extremely important for people in our generation because you got to know what your plan is. Let's say that medical miracles keep you going another 10, 15 years, even though you have some health issues.
Yeah, I just got a flyer in the mail about Social Security changing and the laws are changing, and there's some sort of a seminar where you can go to, and otherwise I would just throw it away, and I went,
Right.
Hold on.
Right. No, hold on a second.
Maybe this is something I actually should go.
I am that. Right, exactly.
Yeah. Normally,
Exactly right.
now it's sitting on top of my pile to look at.
So if you're out there and you're thinking about all these things as we are, right? And because it's important for where you're going to live, are you renting now? Do you own now? Do you plan on buying in the future? All of these decisions that you're going to have to make have to be made once you retire. Now, you may keep working at, 65, 6, 7, 8, whatever it is. But at some point, these are the decisions, these are the questions you have to ask. And it's important because your housing needs are, number one, you need someplace to live, you need some money coming in to pay for that, and you need to figure on what's going to happen to your health, i.e. your health care costs become extremely important. Thanks, Daryl, for jumping in.
Pleasure, my friend.
Thank you very much, and I'm Jeff Barton, your host for the show, The Mortgage Voice. I'm here each and every week. I appreciate you all listening, and we'll see you next time.
You're listening to The Mortgage Voice with Jeff Barton. For more on today's topic, visit www.malibufunding.net.